Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. This is going to be your daily cryptocurrency market, ladies and gentlemen. And let me just start off by saying there is crazy shit kicking off across the board, guys. It looks like an absolute financial, economical nightmare that we are potentially heading into, and we're going to cover some of that in this video. Not to depress anybody, it's Friday, enjoy your weekends, guys, but there is some seriously crazy shit taking place, and we're going to be talking about it in this video. We're going to be going over one of my main concerns, and that is the fact that we are just getting into this recession, and we're yet to see, and we're going to be looking at the unemployment rate. We spoke about this with Francis Hunt, the market sniper. He also demonstrated that we are at that key inflection and turning point for unemployment to start rising as it does. And we're at the kind of start of unemployment starting to rise. And this is, again, why, if you look at the macro, and I know it's becoming a bit of a meme now, calling for the macro, it really is a negative picture. We've been on this train for a while now, and we're going to stay on it until we see some sort of a pivot or reason to do so. But from where I'm sat, and we're going to show you a lot of it in this video, things just seem to get more gradually worse. You know, we know the UK government stepped in. Just quickly before we start with the big event today, which is, of course, non-farm payroll, I'll give you a word of warning on that. We saw the UK government come in and essentially go, we're going to have to buy up bonds. We're going to have to buy up our long-dated gilts, the long-dated bond market, because pensions were looking like they were going to start to, go insolvent in many ways, or bust, or belly up. So this is the fall that we saw for the gilts. This was blamed on Liz Truss's e-mini budget. Guys, whoever's in government, they're all a bunch of clowns. They're all working and part of the same groups. Of course, one's going to be better than, there's going to be a good guy and a bad guy within that, but they're all as corrupt as one another, is really what I'm trying to say. It didn't really have much to do with Liz Truss's e-mini, rather the fact that we see, this is a dollar story. The dollar is the poison pill. And essentially, what you're seeing is the dollar eat everybody else's dinner. People are flying over to the dollar because it has a lesser rate of inflation. It has a higher rate of interest rate hikes. So it's natural that these other currencies, even big currencies like the GBP and certainly the euro, are going to come under fire. They also have their own internal issues. But you can see, since they decided they were going to contribute, I think it was $67 billion to the bond market, it's actually sold off a significant portion of that rally. You'd expect a lot more strength here. And is this the precursor for further downward continuation? We're seeing a similar situation play out in Germany. Lots to get into, like I say, guys. But let's start with today's big news and how it may affect the market. So Friday's job report could be a case where good news isn't really good news. In normal times, strong job gains and rising wages could be considered a good thing. But these days, they are exactly what the US economy doesn't need. Why is that? So you'd think stocks and everything would do well in the US on the back end of a good jobs report, which is supposed to be reflective of how the economy is doing. Well, we know this is a dollar story. This is why it's important as crypto investors and traders to do cross-chain or cross-market, analysis, because markets at the moment, given the kind of driver that we've got, it's almost like levers. When you pull the Dixie lever, the Bitcoin, lever goes up, meaning that it goes down, if that makes sense. So what happens in other markets, certainly the FX market, really the dollar, play into the cryptocurrency market story. So a good job report means that Jerome Powell, he consistently references the labor force as being strong, giving him the kind of go ahead that he needs to continue to up interest rates. He also refers to the unemployment, which we're going to talk about, because this is my real concern, that this starts to skyrocket. He talks about this being at, pretty much lows. So whilst this continues and we continue to get good news, which is now perceived as bad news via the markets, because it means that they're going to continue to hike interest rate more aggressively, even though we're seeing Fed pivot, come back around, this, that, and the other. It's my opinion that the Fed aren't going to pivot just yet. It's my opinion that, and why are they on this crusade that they're on? It's because of inflation. Inflation is not coming down in a kind of informed manner. It's not coming down in a kind of civil manner. It's out of control. They need to put that genie back in the box. It's very hard to do so when it's already got as bad as it's got. So they kind of, inflation is actually, isn't it funny that not that long ago, everybody was saying how dumb the Fed was for not upping interest rates and keeping it where it is. Now they're upping interest rates. Everyone's going, we should fight the Fed. and essentially, you know, even the UN calling for the Fed to back off. So it's very, very interesting. This is what I mean about crazy shit is taking place. So back to the jobs report. So what does this mean for crypto? Well, you guys should be telling me at this point. Essentially, a strong dollar is bad for Bitcoin. So when dollar goes up, Bitcoin goes down. Also correlation with the stock market there. Remember, this is all a liquidity-driven game. A good report is probably going to factor in or be deemed that the dollar is going to gain strength off the back of that, which is going to be negative for markets generally. And we've had some pretty good reports so far. So economists surveyed by Dow Jones expect the report will show that payrolls increased by 275,000 in September, while the unemployment rate is held at 3.6%. We're going to talk about the unemployment rate because I think we're at that turning point, that inflection point where we, you know, see that continuation, and we can look at actually the civilized labor force levels because we're back pre-March 2020 events, which is all very interesting. So an upside surprise could mean a more aggressive Fed that could roil markets, what we were talking about, along with the headline job numbers. Investors will be watching wage growth very closely. So absolutely, this is going to be market moving. I'm not positioned right now, to be honest. There'd have been no point positioning this morning. Been watching the market since early hours of this morning, obviously starting with the Asian markets into the UK, and then looking at crypto and the US futures markets and the Dixie. Why would you trade this? No point in trading this yet. I'd rather wait until we get, you know, the side of this FOMC. It's very much 50-50 here, guys. I can see the bullish case in the short term, and I can also see the bearish case. And the real bearish case is the fact that we're in a macro downtrend. You guys know that we've got lots of things that we think are going on. We are looking for downside. We think around about 13,800 is where Bitcoin is going, in my opinion. We've had that target for a long time. Seen it now becoming quite a few other people's targets. We got that target from our head and shoulders, and we do think it will make its way there. We're just sort of waiting for that catalyst to take us there. Once you start running into these stops, just like we've done previously, you know, it's game over. Nobody's going to want to hold that up, certainly in this kind of environment. So it's going to be an interesting day. Remember, just watch out for good report, bad for Bitcoin, bad report, maybe good for Bitcoin. You know, who knows with these markets how they're acting right now. But from a trading point of view, I'd wait and see what the results are before positioning. Yes, you might miss out on that initial move, but you'll certainly catch, you know, the kind of ripples from whatever comes. Let's talk about my big fears. This is from Dylan the Clerk. Take a look at what the labor market did during past Fed tightening cycle, subsequently recessions, and look where we are today. Pain is coming, and this time it's a policy objective. So Francis Hunt, please, if you've not watched my interviews with him, the guy is a market genius, ladies and gentlemen. I've been watching him for a long time, and I've never seen anybody else be as accurate about so many major things. So definitely go and give my interviews with him a watch. Also head over to his channel. But he pointed this out a long time ago, and the fact that we're at this kind of inflection point. So when unemployment is low, typically this is the highs for your stock market. So when we're at these low points, here being one, unemployment is down here. So it's natural to suspect when you've got a strong economy and, you know, there's loads of jobs going, unemployment's low, you know, things are going to be looking good. The issue is with this is look what happens when we enter all these recessionary periods, which is colored in the dark gray. You see a spike up. And I believe that we're on that turning point. And I think, you know, when we look at the yield curve inversion and everything, I think the narrative that's going to be attached to that is going to be a debt crisis. We've explained how money works. And why it's what we saw in the UK is so scary, and what we're potentially going to see in Europe is also very scary. If you have $1 trillion of money, you also have $1 trillion of debt, because this is how money gets printed. This is often represented, so this is the bond market, and this is the actual money. The system inherently has to be inflationary, because when you lend money out or you create it, you print it via issuing debt on the back end of it. There's a liability and an asset. Problem is you need to find more money to pay that interest off, and it leads to more and more printing. The problem is the whole credibility of the system lies within the debt that backs it. And we're seeing, just to reference the government yield, the UK government gilts here, this is only the 10-year, but the 30 looked pretty brutal as well. You're seeing bonds lose credibility, massively lose credibility, after essentially being on and this probably isn't the best one to show you, you know, a 40-year bull market. So remember, yields are inverted. And what the government's done doesn't really seem to be doing that much. And this is really my fear, because I think it's very likely that we're going to see unemployment really start to tick up as it has done previously. Unless we see some sort of major inversion of the war ends and the Fed goes, okay, we're going to revert, then maybe we can start getting bullish on markets again. But until we've got through whatever shit show we've got to go through, we're staying very much sidelined in stable coins. And it's not to say there's no risk there. There's opportunity risk that you're taking if you're sidelined. But you know, when I say we're going to see the fund rate, we're going to see a pivot. We'll see it in the futures market first, in my opinion. Something will happen, and then they'll start getting priced in reverse. And we know the correlation with the futures market for the interest rate market and Bitcoin. So this is my real fear. This is something that I think is coming. Please go and watch again my interview that I did with Francis, because you'll see we talk about it in a lot more detail. This, in my opinion, is going to tick up. When you're at high points on unemployment, you're at low points in the stock market. So low points on unemployment, high points at the stock market, high points, low points. You know, you can see this was the March 2020 spill with unemployment going through the roof. It's how it goes. There's huge correlation there, which is why it's important to do the cross-chain analysis. We're also seeing the labour force at levels that it was sort of higher than levels that it was pre March 2020. This is some news out of Germany. Germany's relief plan could trigger a UK bond-style meltdown in Europe. So back to money. You know, the thing is with it is if you have hugely high inflation and you offer a bond that pays you 4%, inflation's at 8%, why would you want it? Devalues the debt. So the thing is with these relief plans that they're putting out, just like why the Bank of England and what they're doing isn't going to work, is it undermines the whole narrative of the fiat systems themselves because they're backed on debt. So basically they're saying, you know, it's just a clown system as it is, one that I think is destined to fail. I think we're going to see it in our lifetime. Is this sort of the precursor into that? Maybe. It doesn't have to be. Could be something around the corner. But things do not look good. And this is all going to... All of these things are major things that are going to factor into markets. And this is why, you know, they're talking about, in Germany, a UK-style bond meltdown, which is probably going to lead the euro to step in. It's a death spiral for the eurozone and the currency. It's why we've been, and my community has been, in dollar stable coins for months now, ladies and gentlemen. This is from the Market Sniper. Pensions are clearing out UK government debt and other assets to meet liquidity requirements, aka have sufficient cash to pay existing pensions, while the Bank of England hold up the other end of a toxic bank. So going back to my point that nobody wants, but what's happening in the bond market should be of grave concern to everybody. I really do believe that. And to expect that not to shake up other markets is beyond belief. This is the BBJ. ECB concerned about potential wave of defaults on banks. So talking about this unemployment rate, how does unemployment start to skyrocket again? Well, through essentially debt failure, defaults. You know, everything getting more expensive, people having to lay people off. We're already seeing it, but I think that tidal wave is yet to come. And I think this winter, you may see it. They said banks were more capitalized in 2008, which is not a great reference. This was another interesting article. We should fight the Fed because it's fallible. Investment advisor said, the Fed don't give a damn about your investments. In fact, they probably have a vested interest in taking them from you, getting you back to work. If the Fed gave a damn about your investments, they'd have stopped way before the stock market got to 31% down. This is devastating. You know, we've seen more wealth destruction this year than I think ever. This is, in my opinion, a recessionary sort of precursor to further downside. We think you're in a 2008, 2000 environment. And if you've been with me watching this channel, you're ready for that. Maybe it doesn't happen. We've still got exposure to the crypto markets and we'll see the signs of it. But to me, simple risk to reward tells me that I shouldn't be holding a large position in risky assets that we've seen really dance to the macro beat, which looks bleak. So interesting that they're all talking about fighting the Fed now. You know, start of the year, they were talking about how they need to be aggressive, blah. This is from Fed's Wallet. I am not considering slowing or stopping a rate increase due to financial stability concerns. There will get a point where they have to, but I think they're gonna take it to the point when they have reason to pivot and go, okay, well, we've broke this market. We're gonna have to renege and revert, or not the market. Sorry, that something serious takes place and then they have to renege and revert. But then what does that do for inflation, which is kills off the masses? If you've got £20,000 in savings and you've saved 5 years up for it or whatever, you've actually lost out massively just by having that sat there, because your fuel's more than doubled. Your bills have more than doubled. So that money that you have is now worth less. Still $20,000, but in the grand scheme of things, it's worth a lot less. So it's a really interesting time to be alive, if nothing else. I find all this stuff fascinating and interesting, and trying to navigate it is often easier than said. But for now, we're out in terms of investors, traders. Not going to take a position until I get non-farm. We've been pretty accurate. For anybody that wants to join me in trading, you can join my Patreon. It's just a part of what we do. I trade every day, so it makes sense to sort of share my thoughts. Great way for you guys to learn in a safe manner. Remember, trading isn't a safe game, and there is one guarantee with trading, and that is that you are going to lose money. You just hope you make more than you lose. But I've been rambling on for long enough now, guys. We're still biased more downside. Crazy shit is taking place. Just, bear all this in mind. You guys make your own decisions. I'm not telling you to buy. I'm not telling you to sell. I'm telling you what I think. You're adults. Come up with what you guys want to do based on some of this information. And don't just take my view. Look at other people's views. I'm sure there's people out there that are bullish on the markets. One thing with that is these people have been bullish at every single bottom. They called the bottom here when we said it wasn't. And you've actually slipped and put in new lows in terms of candle closes. So they were wrong on that account. My bet is they're going to be wrong again. All I've got for you in this one, guys, if you enjoyed the content, like, it's always appreciated. So is a comment. And I look forward to seeing each and every one of you in the next YouTube video. Thanks a lot for watching, ladies and gents.